Unexpected events can certainly put a spanner in the works of our financial sustainability. In this video, we're going to look at how to deal with those unexpected events, what sort of measures can be put in place to avoid them. Within this video, we're going to look at unexpected events that could affect your financial situation. We're also going to look at ways to deal with those unexpected events. So what unexpected events may affect an individual's financial situation? Things like inheritance will mean an unexpected income. A lottery win will be the same, an unexpected income, which may be a substantial amount. We also may get birthday presents, and we also may benefit from promotions at work, which might come with increased salary. Marriage, of course, means that we'll have to spend an awful lot of money on getting married in many cases. However, redundancy will reduce our income, and we may be required to live off benefits for a while. Reduced hours at work may have a similar effect in that it reduces our salary, and a pet illness would increase our expenditure. House repairs would have the same issue, and a house burglary might mean that we need to replace items within our house, especially if we did not have insurance in place. A stock market crash could mean that our investments within the stock market generate a less of a return, and a divorce may mean that not only might our expenditure increase, but our income may also go down. So how can we deal with unexpected events? Well, we can be proactive and put insurance into place. There's four main types of insurance. Firstly, general insurance. Now, general insurance covers things like cars, buildings, home contents, travel, and pets. So general insurance means essentially you're paying a premium in advance, and if something bad happens, then you get compensated, or you get a payment, or you get payout for it. Life cover, on the second hand, is designed to protect other people from the financial consequences of someone's death. So, if you are the main breadwinner, the main earner within a family, if you died, then that would leave a significant gap in income for that family. So life cover protects the family or the people who survive the deceased from the loss of income. Health insurance is used to protect people against the financial loss of being too unwell to work or being diagnosed with a critical illness. So health insurance, if you're unable to work, will continue to pay your salary or at least a proportion of it. Pensions, on the other hand, enable people to save for their retirement. Essentially, over our working life, we'll pay national insurance, which contributes to our state pension, but we may also wish to contribute to a private pension to boost our income within our later stage of life. Now, some key words you need to be aware of when it comes to insurance. The first one is premiums. Premiums are the amount you pay to the insurance company in order to receive that level of cover. Those things which increase your insurance premium is to do with your risk. If you are higher risk, you are likely to meet a higher premium. We'll look at the things that increase insurance risk later on. Now, the third thing that you need to be aware of is car insurance types. There are three types of car insurance that you may choose to get when you begin to drive. The first one is third party only, TPO. This essentially means that if you have a crash and it's your fault, the insurance company will cover the cost of repairing the third party's or the other person's car, not your own. Third party fire and theft, TPFT, is you get all the benefits of third party only, but you will also be covered if your car is damaged through fire or if it is stolen. Fully comprehensive car insurance, on the other hand, is where you will benefit from all of the previous types of cover, but you'll also be covered if it was your fault and you crashed. The cover will also cover your car and any repairs or replacement that is needed to your car as well. Now, generally, because fully comprehensive covers the most amount of things, it is the most expensive form of car insurance, followed by third-party fire and theft, and generally cheapest is third-party only. The difference between home and contents insurance is home insurance protects the building, the roof, the walls, etc., whereas contents insurance protects the things within the house itself. So what factors affect the cost of an insurance policy or premium? Well, firstly, whether you pay your premium through monthly payments or you pay it in one annual go. Generally, if you pay it annually in one go, your premium will be lower than if you'd paid it in monthly installments. The term length of insurance will also obviously affect your premium. If you want car insurance for a day or a week, it's going to, of course, be cheaper than if you want it for a year. The amount needed to put things right. So if you did have a crash, for example, in your car, how much would it cost to put things right in your car? If it's a very, very expensive car, for example, it would cost more to put things right. Voluntary excess. Now, this is the amount you are willing to contribute if you make a claim to the cost of the repair. So if you have a crash in a car and you claim on your insurance, then it's the first amount you are willing to pay in order to contribute to the cost of the repair. If you volunteer to pay a greater excess, then it's likely that your premium will reduce. You may also have built up something called a no claims discount. Now what this means is over a number of years, if you have not made any claims on your insurance, you will build up no claims discount or no claims bonus, which essentially means you will have a discount on future premiums. It could be up to 50, 60, maybe even 80% of the cost of a premium compared to someone who has not got a no claims discount. Now, are there any other factors that increase the risk to the insurance company? Well, if you have made previous claims, that signals to the insurance company that you are more of a risky client to have, and therefore it's likely to increase your premium. Your age and experience can also potentially affect the level of your premium. With driving, for example, if you are just starting out in driving or you've just passed your test, your premium is likely to be significantly higher than someone with 20 or 25 years experience, depending, of course, on whether that person with 25 years experience has made any past claims. Your occupation in some cases can affect insurance. For example, with health insurance or life cover, if you do a job which is particularly risky, your level of life insurance is likely to be significantly more expensive. Underlying health issues could have also contribute to higher premiums when it comes to health insurance. If you have a chronic illness, you will have to pay significantly more in premiums than you would someone without those chronic health conditions. Lifestyle choices may also contribute to greater insurance premiums. If you smoke or drink heavily, health insurance is likely to be more expensive. So what other ways are there to manage unexpected expenditure? Well, revising budgets. If you come across a time when you have unexpected expenditure, then revising your budget would be a good place to start. You may therefore have to spend less on discretionary items, for example. You may also, if you've got one in place, use your contingency fund. If you've got unexpected expenditure that you must make, having a contingency fund in place will essentially give you a fund to use if there are emergency unexpected expenditures that need to be made. The third point is to borrow money. We've looked at borrowing in a past video, but you may wish to arrange an overdraft, take a personal loan, or other form of borrowing. Fourthly, benefits. Now, if you find yourself out of work, for example, with unexpected expenditure, you may wish to approach the government for support. You can claim all manner of benefits, including job seekers' support. How do we manage unexpected income? If we get income through unexpected or unearned sources, there are potentially four things that we may wish to do with it. We, of course, could go out and spend it. We could go and have a good time, spend it on discretionary items. We may also choose to save it, potentially contributing to our contingency fund. A wise thing to do would also be to pay back borrowing. When we pay back our borrowing, of course, it means that we no longer get charged interest on that borrowing. We may also, as I said earlier, create an emergency or contingency fund. This means that if we have any unexpected expenditures we need to make in the future, we have a fund ready to pay off those expenditures. Full Part B written exam case study evaluations are in the pipeline. Make sure you hit the like button and subscribe to this channel for future related videos.